Good afternoon, everyone, and welcome to this webinar on International Biotechnology Trust. The end of the tax year is looming, which means many of us are thinking about ISAs and what we want to invest in over the long run. So this month we'll be hearing from a number of managers running funds which we think could be interesting long-term investments. IBT has been the best performing biotech trust in recent years. And while biotech has a track record of delivering high long-term returns, the sector has actually been quite muted for a number of years, at least compared to large cap tech. So for that reason, we think it could be an interesting time to be considering taking some exposure. Shortly, we'll be hearing from managers Elsa Craig and Marek Borszczynski. We have around half an hour reserved for the presentation and then 15 minutes or so for questions. Please put any questions you'd like to ask in the box on the right, and I'll put those to the managers at the end. So Elsa and Marek, over to you.
Thank you, Thomas, and thanks, Kepler, for inviting us to present today. And most of all, thank you to all of those who have dialed in. As Thomas said, this is going to be an introductory webinar covering IBT and the team. We'll kick off with performance, talk a bit about what's been going on in the biotech sector and how our portfolio is structured. And Marek's going to come in the second part of the presentation talking about the sector and the outlook of that. So just to taking a step back, the fund itself, the trust, is 30 years old, celebrated the 30-year anniversary last May. And it was started as a way for UK investors from retail all the way up to the big institutions to get access to the whole cross spectrum of the life cycle of a biotech company, if you like, starting from how biotech companies are born. So companies moving out of university, getting venture backing, as we have a small portion of the fund invested in venture funds. And then the rest of the portfolio is invested in NASDAQ mostly listed biotech companies, all the way up to very established, profitable names, but covering the whole spectrum of the industry. So I'm just going to move to the team slide. My background is scientifically trained and started following biotech companies in 2001, so well over 20 years ago now. I've previously been at Barings, Rothschild and Insight Investment, and then joined this fund, this trust, in 2006. And some of you may know, but we moved the fund from a venture firm in November 23 over to Schroders, but the team's the same, the mandate's the same, and I'll come on to all those details in a bit. But Marek, perhaps you could introduce yourself.
Thank you, Elsa, and thank you everyone for calling in. So my background is scientifically trained, and I did my first 12 years in the industry working with in-licensing and out-licensing of projects. So I've been working with drug development half of my career, so to speak, and joined IBT in 2013. I've been here ever since.
It's been actually very helpful having Marek and working with Marek, because he does have the experience actually at the coalface in drug development, and is therefore able to bring the expertise and experience into managing a fund that he's gained through working within the industry. And it's a very different skill set, discovering a drug, developing a drug, and commercializing a drug. It's sort of three sets of skills, and it's been incredibly helpful having that know-how when selecting stocks. The other thing Marek brings to the table is he used to work in business development, and I think that might be why we've had a good hit rate on M&A deals in the fund. He obviously understands what pharma are looking for, and most importantly, how they value companies. They are valuation sensitive. Right, so I mentioned we've moved to Schroders. I don't think we need to dwell on this now. We've been nearly over a year here now, so we're very much settled in, and it's our 4-year anniversary. I forgot to mention this, that Marek and I have taken over as lead fund managers. Okay, so as I mentioned, this trust gives our shareholders access to the innovative part of the pharmaceutical development industry, if you like. So fundamentally, we are exposed to biotech stocks and then benchmarked against that, benchmark over in the US, And it's these innovations that tend to get picked up by pharma. And they do that because they're losing revenues from their top line every year or so from IP expiries, and they need to replace those sales. And what they do is they acquire a biotech company, and we're in that sweet spot of innovation. Performance-wise, we've outperformed our benchmark over 1, 3, 5, and 10 years to the end of January. Volatility historically has been low relative to the benchmark, and I can talk about why that is later on. We also pay a dividend out of capital, and this is 2% installments twice a year, so 4% of NAV. And obviously, if the NAV were to fall, then the payment would fall on an absolute basis. And if the NAV goes up, then the payment will go up on an absolute basis. Backed by an experienced team, we also have other funds, obviously, at Schroders who focus on healthcare and venture, so we can liaise with them and discuss ideas. Okay. So here you can see the performance. I know that we were told that we might have some formatting problems on WebEx. So those squares aren't meant to be blank. I don't know if they are for you, but however, these numbers you can find on our fact sheet on the website. But just to reiterate, the fund's returns have been strong versus our benchmark over every time metric. And the usual disclaimers I urge you to read. This will be on the website that you can read in your leisure. Okay, so to summarize, we have a different strategy to maybe other funds in that we do both top-down and bottom-up management of the fund. When Marek and I took over in 2021, we felt there were pockets of overvaluation in the biotech sector, and we're quite valuation sensitive. And so we tilted the fund into the more defensive side of the industry, so the profitable larger names within the biotech industry. That protected us on the downside when there was a correction. And then recently, so in the last 6 months, we're doing the inverse of that. We are tilting the fund out of the defensive names into the where we see value, which is the mid-cap companies at the moment. And then in terms of a bottom-up approach, when we select stocks, Marek's going to run through the characteristics that we look for in a stock. We also try and reduce our positions going into what we call binary events. This can help preserve capital. If there's a clinical trial that blows up, hopefully we can prevent losing money. And then we'd rather buy that back more expensive on a successful trial. M&A, I mentioned, is a big hallmark of the biotech life cycle. We've had a number of acquisitions. We've got a slide on that we can show you, but most importantly, we had our third time in January this year where our largest position in the fund was acquired. So Horizon for 28 billion by Amgen, Seagen was bought by Pfizer for 43 billion, and Johnson & Johnson was bought Intracellular for 15 billion this year. So these have been big deals, and it's helped our performance. Gearing, because we're a closed-ended fund, we can gear. And this is helpful again when, let's say, you have a market correction, we can up the gearing and not have to sell some of our investments in order to capitalize on that sell-off. We have themed baskets. This is where instead of going into one company and backing one horse and holding it for 10 years, we will diversify into a number of companies. And then as and when we see data come out and which one's going to sort of win, we can sell the losers and buy the winners. Something of note is that we have reduced our oncology exposure in recent months, and we feel that's because it got slightly overcrowded. Again, this is something that we can come on to in more detail later. So I mentioned that I started following the biotech sector in 2001. Marek was 2002, so about the same time. And many of you might remember that was coming out of a dot-com bubble. So since then, we've had about 3 or 4 of these cycles where the sector goes in and out of favor. It's something we feel like we recognize now, and we're sort of familiar as to where we are within the cycle of the biotech favorability. On this slide, we've just talked through, they're pretty self-explanatory stages of where the sector goes. We would say in the pandemic, there was a big sort of euphoria stage, and certainly valuations we felt got ahead of themselves. We had the inverse of that in 22, in June 22, when a lot of stocks were trading at less than the cash in their bank. And we think at the moment it's a more normalized market. So it's a more stock picking environment. companies aren't completely extreme on their valuations, more normalized. The IPO window's creeping open. We've had a few IPOs come out. Secondaries are going okay, and we've had a sort of emerging again of M&A. So we think we're sort of stage 3. This is normally the longest stage, and we're quite happy with this one. Okay, I'm going to hand over to Marek to talk about the characteristics that we look for in a company.
Thank you, Elsa. So as Elsa pointed out, we have both a top-down and bottom-up approach. So from top-down perspective, we try to be balanced when we're choosing stocks. So we think about the market cap. We need to have a portion that are large enough, cash flow generative, like an anchor in our portfolio. Then we think about diversification. We cannot want to put all eggs in the same basket. We think about different therapeutic areas, but also macro environment, interest rates, etc., inflation. That is very important because some of the companies, at least on the smaller end of market cap, are very sensitive to interest rates. We'll come back to later. So that's the macro backdrop. But when it comes to bottom-up approach, how we think about it is that a company preferably should own their own asset, meaning that the project they are developing they own outright. They have not licensed it or licensed out because that diminishes value and potential for being acquired. Obviously, they need to address an unmet medical need because we believe that if you can address an unmet medical need, you have a much better pricing power in terms of going to the governments and actually propose that you actually address something that is needed. Monopoly position, if you're the only player on the market, it's obvious that you will take the market. You need less sales and marketing teams, but also you can extract a higher price. Management is very important when it comes to small biotech companies because there are very few of them, and we prefer having teams that have done it before because we have circulating teams sometimes that have done it several times before, often backed up by reputable venture companies and investors. That is also something we look into. So there's a lot of criteria we look into when it comes to the management, but also the company needs to be liquid enough in terms of being able to trade. As previously mentioned, we think about the binary approach. We don't want to own a company going into very big events when the company can blow up. So this is how we view on companies. And as a kind of anecdote in terms of stats, there's around 1,000 companies globally we kind of think about in our universe. And if you think about it, only like 5 to 8% of these companies actually pass. And this is the kind of number of companies we invest in, between 50 and 80. It depends on how we operate. But just to give you a flavor of how selective we tend to be when it comes to biotech and the companies within the sphere. Okay, if you change the slide, as previously mentioned, the interest rate sensitivity. If you think about from a biotech perspective, a company usually takes 10 years from discovery to an approval. It's a kind of round number, but it gives you a flavor of how the development time takes. For that perspective, this is why US 10-year yield or interest rates are very sensitive because the cost of capital is very highly tied, connected to valuations of biotech because you have all the costs coming in front of you and the revenues are 10 years down the line. As you can see on this graph, you can see that when the Fed peaked their interest rate in October 23, the MBI index or the XBI index, which is corresponding with smaller names in the index, nosedived. And this is the time when we increased our positions because we believe the interest rates peaked at that time and the valuation of smaller names were subdued. And we have seen oscillated when Trump was elected. We saw an uptick, but that's of different reasons. But in any ways, I just want to kind of point that there is a high sensitivity interest rates versus valuations in biotech. Also, why is it a good time to invest in biotech? I mean, we know what's going on in the world at the moment, politically, inflation, interest rates. But on the left-hand side, as you can see, the light green is the S&P Biotech, which corresponds to the smaller names in the index, and dark green is the MBI index, the Nasdaq Biotech Index, which is more market cap weighted. And what's interesting to see is that during the pandemic, the biotech stock market went through the roof and then corrected very quickly. Firstly, overvaluations, and then interest rates took the wind of the sails for biotech, whereas S&P 500 has continued up uninterrupted until just of recent. But what's interesting is that this industry has a very, very long, good tailwind. Growth has been historically around 10 to 12%. And as you can see on this graph, we're basically on the same level as we were in 2018. So 6 years of consolidation in the industry, which bodes well. We believe that a lot of poor companies have either wound down being acquired or just went out of business. And we believe those who remain are more of a qualitative nature. On the right-hand side, tell sign of why we believe biotech is in a kind of poor valuation state is that this is a graph telling how many companies are valued below the cash they have in the bank. And as you can see, we have never seen a period in history when it comes to biotech where so many companies are valued below their cash in the bank. And it's a sign that we hopefully think we will have a recovery. And if you carry on, Elsa mentioned the M&A is a big feature in the biotech. What has been a fact and feature the last 10 years is the biotech has become more and more of an innovative hub, whereas pharma are the ones acquiring companies and distributing the drugs. So we have division of labor, as you might say, where pharma acquires the talented or the good projects, put them into their machinery and goes out and market it as quickly as possible to harness as much value as possible. As you can see, normally we have a premium of 70%, give or take, on a day of acquisition. And we have had 27 M&As during the last 5 years. One thing that I want to point out is that during the period between Feb 24 and September 24, approximately 6 months, there was a hiatus of deals being made. One of the reasons we believe is that the FTC, the Trade Commission in the US, has been very, very adamant of not allowing any deals to go through. And since we have had a new administration, they have loosened up, and we believe, and we also seen factually that deals have been made. So we believe that that's a good tailwind for biotech, and it's the nature of the beast that biotech companies gets acquired. It's the natural evolution of a company's lifespan. Change. And so why do we believe pharma needs to continue to acquire companies? This is a graph showing how much of current sales is at risk of being of patent expiries. As you can see, there's a big patent cliff coming in 2028. More and more sales is exposed to genericization, which means that pharma needs to fulfill their own pipelines, and therefore they need to acquire more and more of biotechs. And one fact is that in 2024, 70% of all drugs approved emanated from biotech, which is an interesting, astonishing number considering 10 years ago it was the opposite. So when it comes to biotech, me and Elsa took the approach that it's very, very hard to pick a winner when it comes to development. There's so many stumble blocks that can occur. But we believe certain areas are very, very hot and very the development has reached a certain point when they can come to fruition. One of them is central nervous system, meaning ADHD, Parkinson, Alzheimer's, everything that has to do with the brain. We believe this is an area, also depressions has been less stigmatized since the pandemic. We believe this is an area where pharma have shown a lot of interest and a lot of scientific breakthroughs. But addressing smaller names, we believe that we should invest in several of potential names. And once they've proven themselves, we tend to increase our position in those names. And that lowers the inherent risk of developing drugs. And this is how we operated when I worked in the industry. We had usually a portfolio of projects just to mitigate risk. Same applies to emerging oncology. Obesity, which we might come back to later on. We believe we think about obesity as the next generation drugs that Eli Lilly and Novo Nordisk do not have at the moment, that addresses certain backdrops of problems that currently inherently are with current obesity drugs, like vomiting, nausea, injection site reactions, and also muscle wasting. And this is the areas we believe will be addressed with the next generation drugs. So this is an interesting slide showing where and how we invest our portfolio. Coming back to the allocation of portfolio, how we address that. It's very obvious to say that US is the main market in terms of development, and also the most evolved market in terms of where people put their headquarters. Many promising European companies put their headquarters in the US and move their listings, because this is where you get the higher valuation, more sophisticated investors, and the biggest market in the world. So having said that, doesn't mean that the 16% you see on the graph means that the 16% of exposure is in Europe and 80% in the US. That shouldn't be taken for that. On the lower left-hand side, you can see that we focus on rare diseases, oncology, and central nervous system. The reason is that they address very high unmet medical needs, and it's easy to price. And once you get a drug approved, you actually can harness as much as possible from valuations. But having said that, on the right-hand side, on the bottom, you can see that oncology as a drug class or the therapeutic area has become highly crowded. We have seen a lot of overinvestment, if you want to see it from a financial point of view. Many companies chase the same target, which means that finding a winner will be harder, and the winner might not be as a big winner as you might think. So not only do you have to beat the placebo or the control arm, you also have to beat the competitor, not only on safety, but on other aspects. And we believe that has become very, very competitive, and certain pockets of oncology space we have decided to stay away from. And also for UK investors, I think it's very important to mention that the sizes of the companies we invest in is I would say 20% of our portfolio are profitable companies, and many of them in multi-billion-dollar sizes. Like Amgen is a $150 billion company, which is bigger than AstraZeneca and GlaxoSmithKline. And revenue growth, meaning the companies have a drug on the market but has not yet reached profitability. As you can see, at least half of our holdings are in companies that have a drug on the market. The remaining 48% are companies that have, majority of them, at least phase 2 or phase 3 data on their hands. So it's much more mature than you might kind of perceive when you speak about biotech, which is much more mature industry than it was 10 years ago. So coming back, this is our top 10. There might be a reason to come back to discuss this one, but I want to point to you that a year ago, maybe our top 10 constitute of 55-60%, whereas we have now spread into smaller names, which means that we have a smaller position in more names. All of these top 10 have either a drug on the market or phase 3 data imminent. So very relatively mature companies from that perspective. And these are the companies we believe have addressing very high unmet medical needs. And we believe companies are looking at and sniffing around. They can be standalone, but we believe these names might be picked out whenever. I mean, we love the companies for their inherent value, but we believe also that pharma is looking for replenish the pipelines. Okay.
Okay, so Mark, do you want to do the beginning of this section? Sorry,
I will do that very, very quickly. So coming back to how financially how the industry is doing at the moment. Secondary offerings are in healthy state, meaning the companies that are already on the stock market raising more money, those with high quality have a relatively easy time to raise money. IPOs have been relatively mixed, so we have very few and far between at the moment. We have seen that number of new clinical trials are trending up, which is a good sign for the industry. And also, as I mentioned previously, majority of drugs approved actually emanate from biotech. So we have a really good tailwind, long term at least. And if you change the slide, coming back to the tailwind, we have a demographic shift in the world when we tend to get older, and with age, unfortunately, diseases come. And as you can see on this slide, proportion of the people above the age of 65 will go up 200% in the coming generations, which is a big bulk of population. And if you look at the next slide, you can also see that heart disease, which is a big culprit 30, 40 years ago, has been superseded, unfortunately, by cancer. But the good news is that we no longer die of heart disease. We grow old enough to actually get cancer. And good stats is that majority of people actually nowadays that get, unfortunately, diagnosed with cancer survive and live long enough to kind of die of other causes. I think it's a positive sign, even though it's a grim slide from, if you want to see it from that perspective. Next level will be CNS, Alzheimer's disease, which is a big issue at the moment. I think science will solve that. You can see the number of drug approved in the US is on the rise, so it's also a good sign. As we pointed out previously, majority are from biotech, so that's the driver. And coming back to secondary, this is the green bars showing the secondary financing, which has been relatively healthy despite the grim valuations reset we've had. So shows that the specialist investors tend to invest in good quality companies over time. That tends to be a positive for productivity increase.
Okay, thank you, Marek. So just to finish up, we've got a slide talking about the political environment over in the US, which one can't ignore. So as you're probably aware, Trump came in, won the election in the autumn of last year, and there are two sort of major things that we could say were relevant to the biotech companies. The first is that it is a merger and acquisition industry, in that, as we've already talked about a number of times, pharma see biotech as the source of new drugs and innovation these days. However, as Marek mentioned earlier, there was a complete standstill of M&A, not just in our fund, but across the sector, except for private companies. And the view was that, we actually spoke to bankers at the time, that there was a lot of discussions going on behind the scenes, but people didn't want to press the button without clarity from as to who was going to win the election. And why they didn't want that clarity? It was because that a lady called Lena Khan headed up the FTC, and she was very against these mergers and acquisitions. She tried to sue Pfizer for acquiring Seagen, and then Amgen also for acquiring Horizon. So if you imagine it in their shoes, what would they do? Should we wait 2 months and have a more investor-friendly, business-friendly FTC? Or it makes sense. So we can see why deals stopped, and we are of the view that things will pick up. The need for M&A is just getting more and more pressing for pharma. So anyway, that on the one side we think is a positive for the industry. A few weeks after the Trump was inaugurated, we had the intracellular deal. As you know, it was our largest position at the time, 7% of NAV. So that's great news, and we do hope that we'll continue to see more. RFK, however, we would argue it's not specifically, what he's been talking about isn't specifically relevant in our view to the companies we invest in, such as oncology drugs and CNS drugs. So who knows, though? It's unpredictable. However, when it comes to vaccines, I think he's been quite clear that he wants to have more research into the established vaccines, and equally maybe kind of lessen the mandates that you get in the US for the childhood vaccines. Again, something that we don't have clarity on. He has spoken a lot and openly about his opinion on food, and obviously food is the F of the FDA. So he's already been talked about trying to reduce additives and dyes, etc. So it's not just going to be drugs that he's looking at. And then on the caveat to all of that is the FDA, the CMS and NIH are all being headed up by very reasonable and respected people. So we're not too concerned about that. So overall, we think it's net neutral for biotech, positive on the FTC and uncertainty around RFK. So that actually concludes the end of our presentation. Bang on, 2:30. So I will scroll back to the beginning and then hand over to Thomas to navigate through. I can see people have asked questions.
Yeah, amazing. Thanks very much. We do indeed have a few questions already lined up, but if you're in the audience, please do add yours. We've got 50 minutes or so, so you should be able to answer them all. First of all, Elsa, you mentioned intracellular, which was a large position when it was taken out. And the questioner says, congratulations on that one. However, it is a large position, and you mentioned how you like to take into consideration binary events in biotech and manage around those. How typical is this position size, and how do you view position sizing more generally?
Yeah, I think it's an unusual situation to have such a large position, but we've done it before and we will do it again. And it's when there are a number of factors that all coincide. It's unlikely we're ever going to have a position as large as that doesn't have an approved drug on the market, for example. So we're a relatively sort of established company with know-how and maturity. This situation, there was an understanding that they had been approached by Bristol Myers about 6 months before, and this was widely known. But the deal didn't go through, and Bristol picked up Karuna. So taking that on side, taking the fact that it's a fantastic company with high growth, relatively de-risked, as I mentioned, they've gone through the clinic, gone through the regulator, and then we know the CEO very well. And we felt, taking all these things into consideration, we felt this company probably wouldn't remain independent, which is why we took a slightly bigger position than we normally would in this sort of company. So that's kind of how we think about it. And then in terms of portion size, if you remember the rest of the funds that we don't have high conviction on, remember Marek's slide on the baskets. So if we have a higher risk company in development, we're more likely to have that in a basket of companies showing similar, maybe going after the same target, for example, or the same disease area. And so that way we mitigate risk. And if there's one winner, because it's very difficult to predict who's going to win in early stage development. In fact, I would actually think it's impossible. So we like to have a cross spectrum of names. And then if one gets picked up, all of them arise. So that's how we kind of manage position sizes on the earlier stage of the spectrum. I hope that answers your question okay.
Yeah, and we discussed M&A a lot during the presentation, and one of the questions is asking, should we really think of the fund as a play on M&A activity in the sector? I guess maybe what the question is asking, is this the only way that you realize value from holdings?
No,
I can take this. So how we view it is that we look at the specific features of companies that we like, and it just happens to be so that others seems to be liking it as well. And we, as you can realize, that if a biotech has these features, it will not stay independent for longer. So it kind of is catch-22 in a positive way. You have good characteristics, you will be acquired. It's not like a company gets sold. And this is why we believe we have had so relatively good hit rate, because we look at these features, I pointed out, the bottom-up approach, and we see these as good. And the only difference with M&A is that you, in a way, front load the upside. We believe they will grow into the valuation, but if a company is willing to pay up earlier, it is just front loads the upside. So it's not like we are focusing on M&A as such. I don't think that's the way to see it. We can mention a couple of companies. I think Horizon, which is now history, was acquired by Amgen. We saw that the company had a fundamental value, but then it rose 20% above our limit value. Then we thought there is a lot of M&A premium baked into the company, which is not justifiable. And then we sold off, and then it came down and we re-engaged. So we are very valuation sensitive. We are not speculating in M&A. Rather, we are thinking of fundamental value and then front load the upside. I hope that helps.
Yeah, great. Roy says, very interesting presentation. Thank you. Could you tell us, should you think of this fund as a specialist small cap fund, what do you think its role could be in a portfolio?
Well, I think if you think about generalist investors who have a generalist portfolio, they apportion various different percentages of the fund into industrials or consumer staples and healthcare, etc. And we would think that this is kind of a kicker to your healthcare exposure in your portfolio, if you. But this is kind of verging on giving financial advice, but which we're not meant to do. So it's it's the spicier, innovative side of the pharmaceutical industry, if you like.
And I can add to it. Our philosophy is to, since biotech is inherently considered relatively risky, we try to minimize the risks within biotech, the basket approach, the binary event, and the volatility limitations. That's how we try to do it, to make it more palatable for those investors.
I think the other reason that it's useful to have a fund is that it's very time consuming to keep on top of what's going on in these companies, and sort of outsourcing it makes sense in our view. You have to be all over when the news flow is. You have to know whether the competitors, what they're doing and when their news flow is. It's very time consuming, sort of labor intensive to invest in this sector.
And your company's being listed on the NASDAQ, they
mostly
wouldn't be included in a typical ETF or fund that would be tracking the S&P 500 or the NASDAQ. Is that right? So there
are some larger companies, obviously the larger end of the spectrum, that will be in the S&P. Fundamentally, though, it's sort of an incredibly long tail. There are many hundreds of companies in there. So yeah, I mean, it's a tricky area to invest in, and it can be quite high risk.
I have a question about AI. So is the adoption of AI research tools likely? And how could it affect the speed to market and the cost of drug development?
I can start with that. So from my experience within the industry, AI has been used 15 years, but it was not called AI at the moment. It was just high computer throughput screening, etc. You name it. The industry have always used a lot of tools because it's incredibly expensive to develop drugs. You don't want to fail. What AI has helped is, for example, help to structure, finding new potential targets, finding new compounds, eliminating potential red flags in drug development. And on the other side of the spectrum is can evaluate clinical readouts and look in sub-analysis of drugs, etc. But when it comes to the kind of pushing through the system, currently you can't do it in silico, meaning a computer. You need to go through animal studies. You need to do phase 1, you need to do phase 2, you need to do phase 3. You wouldn't dare, because mankind is very versatile in terms of how we are constructed, and this is why it always takes longer than people might anticipate developing a drug. I don't know if you add anything to that also.
Well, it takes time. The bottleneck is the clinical trial. You have to put these drugs through people and animals in order to pass the FDA or the regulators' requirements to sell a product on the market to patients. And you can't shorten that time. There's nothing that takes a period of time. So although there's some hugely helpful things AI can do for data crunching once the trials have happened, and drug discovery at the earlier stage, which, as Marek is saying, has been going on for many years, actually, it's not going to necessarily shorten the time to drug approval.
Thanks. We had a question on the dividend yield, which I wonder if you may defer to the board, but it's asking about the logic of the paying 4% out of capital. So let me read it. It seems counterintuitive to be converting capital gains at a lower tax rate into income with a higher tax rate. If shareholders need income, can they not just sell shares and not disadvantaging other shareholders with an income liability?
Yep. So you're absolutely right on the tax implications. So taking a step back, and Thomas is right as well, this was a board decision back in 2016, whereby, and they do a strategy day every year to think about how to increase the demand for the shares. And at the time, we were trading at a wide discount, and they were advised that there were a lot of income investors out there that wanted biotech but couldn't get exposure to biotech because they, obviously, you know, they didn't have a dividend. So they introduced it, and immediately we stopped the buybacks, and we traded back at a premium, and so that benefited all the shareholders. If we didn't have this dividend, we would probably be a lot smaller, ironically, because it's certainly a very popular aspect of the trust. Now, in terms of paying out of capital, as we mentioned just now, we do get a lot of M&A. So the way we see it, although our companies don't have natural income, we are getting cash in, extensive cash in from deals. So that one deal in January, we got 10% cash, which more than twice is the yearly dividend payment out. So that's kind of how we talk to investors about it, even though it's not a natural dividend income.
Great, thanks. We do have a couple of minutes left, so please, if you have any final questions, do put them through. The question about the GLP-1s, if they're so effective at reducing obesity, have they changed the market when it comes to lots of other drugs? So there's some areas of research that are less lucrative and less in demand because the conditions are linked to obesity.
It's a good question. I can start with that. I mean, the sheer volume, and maybe you saw the slide in terms of demography, and it's a global kind of trend anyway. So just the sheer numbers, and obesity is unfortunately increasing anyways, and very few have access to the drugs as we speak, and they are not like safe free, so to speak, because once you lose the weight, you lose a lot of muscle mass, and you might have other issues, and as soon as you get off these drugs, you tend to regain the weight and fat. I don't think it's a panacea. And oncology drugs, I mean, in terms of heart issues, they have shown of course a much better outcome. That is for sure, and they will probably help on a relative basis, but on the sheer numbers and the unmet medical need, it will not stop. I don't know, Elsa, you might have more in
I think, you know, that I think if what you're saying, if I understand the question correctly, it's like, is this like a cure-all mechanism? And, you know, as Marek mentioned on this slide, when heart disease has been addressed really well by treatments, so stents and better preventative diet, etc. But stents and statins certainly have helped people not keel over at 55 of a heart attack. But now, of course, that means that they live for another 20 years and they get other ailments. So if I doubt we're going to solve a problem with the GLP-1s, but it's certainly are very effective at losing weight, and the knock-on effects are, for example, with as we're just talking about cardiovascular disease events, are material. And then we've got a major clinical trial readout this year, actually, which is looking into the benefit to Alzheimer's patients. So let's see if it works there as well. Have you got another question? I think.
Yeah, we've got another couple. Hopefully you can try and squeeze them in. The gearing, could you tell us a bit about how it ranges over time and how the fund is currently geared versus that typical range?
Sure. So I'll go super quickly. We don't really ever have cash. You know, you give us your investment money to invest in biotech, so that's very unlikely. But we do, as we said, tilt the fund, tweak the gearing up and down depending on if we've had a sell-off or not, and we see opportunities. So this means we don't have to sell stocks, right, to buy other ones. We have a relatively high gearing position at the moment compared to the last 10 years, and that's because of this positioning in the cycle. We genuinely think we're sort of, you know, we're more positive on the outlook at the moment than we were, say, 3 years ago, 2021. So we've got about sort of low double-digit gearing position. We normally are sort of 7, 8, 9. We had a big gearing position in October 23 because yields spiked. And that went to 15%, and we haven't had that big a gearing position since Bear Stearns in 2008. And sorry, what was the second question?
So other than using cash returns from M&A to fund dividends, what are your other current targets for capital recycling?
All right. So in January, we were in San Francisco when the deal was announced, meeting all these companies, which is the biggest healthcare conference of the year. It was fantastic timing because on Monday morning we sold the whole position in one go. A lot of stocks that there had been M&A speculation around crashed, and we put the money to work pretty much straight away.
Do we have time for one more question?
Sure.
Yeah, I think so.
Yeah. China exposure. What's your view? How much do you hold? Is there a lot of innovation coming out of China? Maybe a quick.
I can take that one. China is coming, no doubt. They have a really good scientists and early stage development, early science is really, really good. What they currently lack is the infrastructure in terms of the financial system, how to finance biotech companies, how to develop drugs in a kind of Western way. But we see a lot of pharma coming in and snapping up them in an early stage. And especially we have seen in GLP-1, and that has been several deals being made, but also in ADCs, which are monoclonal antibodies with the payloads. So there are certain pockets when they excel the Western world. That's for sure. I mean, super good science. But in the current climate, what we focus on, it's an opaque system. China is very difficult politically for us to understand, but also we have not feet on the ground. So what we invest is in companies that have a listing in the US because they have to pass certain criteria to be allowed into the US Nasdaq or New York Stock Exchange. So we have a couple of positions. We have been in and out of those. We tend not to be too exposed, but we are definitely looking for within that space.
Fantastic. Well, thanks, Elsa and Marek, for your presentation and your time answering the questions. And thank you very much to the audience for all those questions. I hope the presentation was useful. We should shortly have the recording available on the website and hopefully the slides too. I hope to see you tomorrow. I think the next trust we'll be hearing from is Alliance Witan. So thank you once again to Elsa and Marek, and have a great afternoon, everyone.
Thank you.
Thank you. Bye.
Bye-bye.